Hey, hello everyone. Chris Martinson here, obviously, and it is time for another episode of Finance University. Hey, we've got Paul Kiker back. Paul, good to see
Good
you again.
morning, Chris. Good morning.
Good morning. Yeah, I love doing these weekly things with you. It's a lot of fun. I like helping to educate people about what's going on, and in the context of that, I end up re-educating myself because there's a lot to know about finance, but I think it's worth decoding. It's worth understanding. And by the way, I do believe
Yes.
that the finance industry, all due respect, but your industry goes out of its way to make things overly complicated on purpose is a
Yes, I
mentor
believe they
program.
do. It's ridiculous. I think the worst thing that the industry did was require prospectuses to be delivered and just inundate the investor with information, and took the responsibility off of the industry to educate and say, this is what you should be paying attention to. Oh, here you go. It's your responsibility to figure it out. So it's ridiculous. Everything's so overly complicated. I don't know if it's ego or pride or smoke and mirrors in a lot of cases.
Well, I think a lot of it falls under the baffle them with BS, right? You just sort of you know what it is? It's the Apple terms and conditions, right? The thing 98 pages you scroll through, who knows what you just agreed to, right? You
Right.
know?
Yes. I was
You
bound and
know?
determined to read the last one, and I got about 30 minutes into it, and I was just like, scroll up. Okay, let's go forward. It is what it is.
Okay, it's just yeah. Yeah, if they make me president, first executive order, terms and services has to fit on a single page and it has to be clear.
The simpler, the better.
Absolutely. Well, I think the tax code could be the same thing, right? I really loved who was it? Steve Forbes, who said he could put his on a 3x5 card, right? It's like, what's your income? And there's a number next to that. There it is, No,
Yeah.
this whole idea that the government's going to shape better outcomes with tax policy by encouraging this and discouraging that. Nah, get out of that business.
No, no. All of the smoke and mirrors allows for more corruption and self-serving interest, quite frankly. You don't know
Yeah.
what lobbyist is pushing the rules and regulations that are coming out.
Yeah. Well, Evie and I, because it seems like all the new movies, like we did this thing every so often. We want to watch something, so you go to Netflix, right? And we spend like a half hour going, no, 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 and then we just go for something that tried and true. So last week's tried and true was Wolf of Wall Street, which is a great movie, by the way. It's
Yes.
really good. I love that scene between Matthew McConaughey and Leonardo DiCaprio, the lunch scene, right? That should just go down in history as like a perfect and crystallized thing about how Wall Street actually works, right? But the whole movie is just this idea that it's a scam, but they show you the erstwhile FBI agent cracking down and they get the penny stock operator, but they never go after the big boys and girls, right?
No.
They pretend as if there are these low life scum who are sort of feeding at the edge of an otherwise proper system. But the whole thing is shot through once you understand, what's going on, right?
Yes, it is.
Because I'm old enough to remember that LIBOR was manipulated by the big banks and central banks. This is all public record, and the only people who suffered any consequences were the whistleblowers.
Yes, yes, unfortunately. And that's not a just society, but there's a lot of money and power and connection behind Wall Street, that's for sure.
Yeah, but I
It's
mean, listen, Wall Street's business is very simple. Their job is to take your money from you.
that is true.
That's
That is true. And sell your product, especially now with private equity coming in before a company goes public, they're squeezing a lot of the returns out by the time it goes onto the market. And unfortunately, what we've seen in the past is the perfect unloading of investments where you give someone about 6 months worth of instant gratification, and then they get into a situation where you can buy it back from them at much lower prices. That's wash, rinse, and repeat, it seems to be.
so how do they run that particular scam? How does that one work? You know?
That's a good question. From what I've seen in the industry, that the private equity will move in, they prepare it, they'll create the marketing behind it, move it to the street, whether those stocks go public, and then you've got this media firestorm that takes place. There's historical evidence to where if it's on the cover of Time magazine or if it's on all over the news media and CNBC and whatnot, that's usually the time you need to start looking for the exit. But it's hard for
Yeah.
people to do because now you've got what these pump and dump schemes that took place through Twitter. I can't remember the details behind it, but there were some individuals that were fined and sentenced to jail for their pump and dump schemes on crypto, because social media is awash with all types of manipulating behavior, because they want to make you feel like you're a part of the herd. We feel a lot more comfortable doing things other people are doing, so they play on our basic human weaknesses and tendencies.
Yeah, it's interesting. So I mean, I remember too. So yeah, some people got pumped and dumped on some crypto scams. But do you remember the SPACs, the SPACs, right? They came and sort of went. I'm sure they're still floating around, but that was a big thing. Like 2 years ago, they were SPACing this and that, billions, some of those tens of billions.
Yes.
80, 90, 95% wipeouts. I didn't hear about any SEC investigations. I'm not aware of any suits being filed.
I'm not at
all. Because that's the big guys and gals doing what they do, right? So you got to know which poker table you're sitting at and you're playing. So, but still, we all have money and we have to invest it and do all this and that. And so there are still ways to be prudent through all of this, which is why, of course, we love working with you. And as a quick reminder for folks here, Paul Kiker of Kiker Wealth Management, we have a Peak Financial Investing, rather, has a arrangement with them. And let me just pull this up and yeah. So as a reminder, anything that you're going to see in this particular video is it's not considered financial advice. This is education. And we are a promoter of Kiker Wealth Management because we believe in them. And we do receive financial compensation for Kiker Wealth Management if and only if somebody like you decides to work with them and an account is opened. So remember, investing is risky business, and you should always consult with your financial advisors whenever you're making a move. So with that, Paul, I want to talk about something real quick. We've mentioned this before. Wework. Wework is that company, for everybody listening, as a reminder, that had this great genius idea, which was they were going to lease office buildings and then chop them into smaller pieces and then lease them on smaller units at a VIG, at a premium. They're going to make the difference between their lease costs and then what they were leasing it out at, mainly to sort of small office workers, people who needed a more labile office situation, people who wanted to do crowd officing or whatever that they called that. At any rate, that was the model, right? And yes, of course, it was pretty easy to analyze. They had lease costs and then they had revenues. And every time I looked at their statements, I'm like, wow, they're hemorrhaging money, right? And they did this in market after market, by which I mean London, San Francisco, New York. And then COVID hits, and I'm like, okay, that's it. This is all over. There's nothing like WeWork. Their entire business model is now destroyed. So I'm watching the bonds, and I'm just completely mystified. Look at that peak in 2020 there, right in March. Like all of a sudden, the market said the bonds of WeWork are now going to be spiking in yield. So we'll talk about some bond math in just a second so we understand this. But that basically means the price is falling. And then look what happened, Paul, from basically April 2020 all the way for a year, the bond prices increased. And every article I'm reading is about how office space is like the killer in this. Nobody's going back to the offices. Everybody wants to work from home. Their entire business model is destroyed, but destroyed on steroids because they did it with leverage. And somehow their bonds are just increasing in value the whole time. And this is where I'm going to have to refer to another movie called The Big Short. That reminds me of The Big Short, right?
Yes.
They were betting against the housing market. They bet right. They bet against a tranche of bonds that were like the ugly ducklings in the mortgage tranches that should have and were just being destroyed in value, but the price wasn't moving.
Yes.
In this case, WeWork's bonds prices are going up while their entire business model is being destroyed, not for like a couple of mysterious weeks while some big boys and girls position and offload to some hapless stooges out there, some bag holders. This is for almost 2 years. They kept that story under wraps. And the whole time I'm just like, I'm stumped.
Well, it's amazing. You have the tremor of the birth pain that initially starts. And that's an indication of the risk that's behind. But then and I never cease to be amazed by, you'll get this initial movement. It makes sense to a lot of individuals. And then there's speculators that come in, whether it's just so much money that was put around, or just the, pushed into the economy, or the speculation of the individual that, oh, they're going to survive on the other side of this. But
Mhm.
they were actually off my radar, because I looked at them pretty hard and I said, that is not somewhere we want to put our client money unless you're willing to speculate in this area. It's, pretty interesting idea, but COVID, like you said, just completely derailed that business model.
Well, it did. So let's look at this again, because I think this is instructive for me. It's instructive. Let's go back to this here. And let's see. I'm gonna maybe the laser pointer. Can you see my laser pointer on your screen?
I can, yes.
A little. Yeah. So here, if you said, you know what, I'm going to short these bonds right here, if you'd said that, you would have been right, but the market would have made you wrong. So,
yes.
So that's an example. I think this is a classic example of how you can be completely right, but that doesn't mean you're going to do well in the markets, right? Because there's in the short term, because there's some other rules being played there. So if you hung on for a while, but look at this, through all of 2021, nothing happens. Through all of 2022, well, now something's really happening. But now here they are yielding almost 90% for the senior unsecured note. So if anybody who bought into a business model where they don't own the assets and you took an unsecured bond, you were taking a flyer. But somebody, Paul, was doing this for less than 10%. I think these are yielding at par, 7 7/8 right there. They got back down to par in the middle of 2021. 100 cents on the dollar people paid for this. And I can't do bond math in my head when they're yielding 90%. If you had $1,000 bond, it's probably worth $100, I'm guessing.
Yeah, I would
something
assume
like that.
in that range. And then you've got a bag holder that comes in at 2021, and you're pretty sure that's not an experienced institutional investor. That's either a new institutional investor that isn't protected by the higher ups, or a lot of retail that came into that situation. So, and the hard part is you can make really good investments. You look at that in 2020, let's say you owned it, you recommend somebody gets out of that, they look at it 12 months later, they go, oh, you've given me horrible advice. Or they shorted that, and no, this is just terrible. But that's why patience and fundamental research and paying attention to the long-term picture and really looking at where you are in the big picture is so important for an investor. And that's one of the things Wall Street's really good at, is just everything is so short-term and social media driven and herd driven now. It's hard for people to stay patient for a year or 2 or 3 year period of time to finish out a cycle on a stock like Wework, or bond like Wework.
Yeah, indeed. But bonds are important because, I do believe still that bonds, well, an old Wall Street guy told me at one time, he said, stocks are for show, but bonds are for dough. So the stock folks, that's where all the flash and the sizzle and this, the Wolf of Wall Street, we're going to sell this stuff, but bonds, that's big money in bonds right there. And plus the bonds are usually, if you get the senior secureds, you actually have a senior ownership stake in the company. So a little bit more due diligence goes in, maybe a little bit. Anyway, I tend to follow bonds fairly closely because I happen to think sometimes they're a little closer to the truth. So not a lot of people know about this. So in the interest of being sort of finance you here, let's talk about the bond seesaw. And so what is the bond seesaw? Well, when the price of a bond goes up, the yield goes down. And when we tip that seesaw the other way, when the price of the bond goes down, the yield goes up.
Correct.
Right. So if I had bought say a 10-year treasury bond yielding 2% a while back, and now all of a sudden 10 years are yielding 4%. Well, you might think, well, somebody else is getting 4%, you're getting 2%. What could really happen to that? Well, given that it's a long yielding bond, it's 10 years, we're going to lose that 2% over 10 years, compounded. It means that the price of that bond might have gone down by 20%, 20%
or so.
Yeah.
And one of the ways I explain it to clients and individuals when I'm talking to them about it is, most people wouldn't even buy a 2% yielding security from their brother or brother-in-law, and much less a friend or someone else. So when the market rate goes to 4%, you're locked in for 10 years at 2%. You have to sell that at the current market rate, which means the other person is going to gain that principal return at maturity, but it's going to be 10 years out. So, you know, a lot of people are in a situation where they were too heavy. A lot of these banks, Silicon Valley Bank, some of these others, you know, it was devastating to them because they were, you know, too aggressive on the long end of that curve, and just I guess didn't imagine rates would move as fast as they did. So that's one of the reasons we had such a, you know, 2022 was the worst performance in a 60-40 portfolio in over 40 years. And a large portion of that was the bond side that did not offset the economic downturn or the market downturn.
Yeah. Didn't we see like both stocks and bonds down for the first time in a long time?
I think it was over 40 years. It was over 40 years of stocks and bonds. So a 60-40 portfolio, which would be 60% equities as represented by the S&P 500 and 40% bonds, is by the bond index, was down on average around 20% last year for the year. So a pretty substantial decline, a lot of damage across the board. And the problem with the bonds, with the Federal Reserve artificially holding rates as low as they have for so long, is you're not getting at 2% enough return to offset that risk in the long term. So, you know, like you mentioned, bond investors, I really like to listen to what bond investors are doing, watch what the bond market's doing, because those are really the smartest individuals in the room, because their margin for error and profit is so much less than what the equity investors are. So they really have to pay attention to all the details.
Yeah. Now, like I said, I don't do bond math easily in my head. It's fairly complicated to sort of work out, you know, the time component. But one way I saw somebody describe this for Weworks, they said, well, when Weworks bonds are yielding 90%, that means that if the current coupon payment was $50, so let's say that's 5% on a $1,000 bond, just keep the math simple, then that $50 represents 90% of the current entire value of the bond.
Yeah, so it would be less than $100. That would be 50%.
Well, this is the explanation that made sense, because I was looking at this other sheet here, which is here's a list of companies and states or provinces, whatever they call them down there in Argentina.
Yes.
And we're looking here at the coupon rates, and I saw these coupon rates here that were over 100, and I was like, wait, how can you yield more than 100%? Right?
That's rare. I've not seen that very often.
Are you paying me to take the bond? So I couldn't understand it, but it makes sense with this. That the coupon payment that's stated on the face of that bond is now going to be larger. So let's say it's going to pay $50, but you're only going to pay $42 for that bond, because people are that certain that it's going bust. But regardless of that, forgetting that the little weirdness of the 100, look at all this stuff going on down this list, right? So here we have a province, you know, that's like basically more than bankrupt at this point. That's what over 100 means. But this whole list is 98 is the bottom of this list. So these are all things yielding in the high 90s. Companies, provinces, big companies, little companies, another province, Mendoza here. So this is really bad. And so this is, again, for people who are wondering, you know, how is, say, Argentina doing? I go to the bonds to figure that out right away. That's where I can tell this is extraordinary pain right here, telling me that there's just something really broken in their model at this point.
Right. Well, the third one down is what the city of Cordoba. So you've got the taxing authority of the city of Cordoba, and it's at 100%, 100.9% on the coupon. So, you know, that's incredible. And two things can do that: higher rates, three things actually: higher rates, increased defaultability, and out of control inflation. Because out of control inflation drives rates higher. Investors know that they're losing money over the long term, and the question is, who's the last to get out?
Yeah, that's fascinating though, huh?
That is, it really is. I saw someone point out what the 100-year maturity Austrian bond put out there was trading at 10 cents on the dollar right now. So, that's the ultimate duration carry trade. So if you really believe in inflation, why are you not, and this is not a recommendation, this is a sarcastic comment. If you really believe that deflation is coming sustained over the long term, why don't you leverage everything you have and buy that 100-year Austrian bond?
Oh man, that makes sense. So yeah. So well, so as I was touring around all of this stuff though, I'm convinced that inflation's going to be a little bit worse than advertised. And so today we just saw inflation come in at 3.2% officially in the United States. That's an 8:30 in the morning reading. Of course, stocks immediately head fake, up, down, then way up, right? Because that's how the markets work. The markets work now. And we saw that work across the whole world. Of course, Japanese stocks, when their markets are closed, middle of the night, their futures market traded in exact synchrony with all that excitement. I'm convinced that those numbers are actually fraudulent for reasons that I talk about all the time. That the statistical wizardry of the BLS, bringing their hedonics, their substitution, their weightings, and things that they play with. So they massage those numbers pretty heavily. I can guarantee you my inflation is not 3.2% year over year. And I can base that on my health insurance premiums, my food costs, my property taxes, the price of gasoline. And I'm really glad I have a car that I don't have to replace because I'm horrified by new car prices right now.
It's ridiculous. We've got to replace a vehicle, and my wife made a promise to our daughter, which we've stretched it out about 9 months. And I'm like, honey, it's going to be another 6 or 7 months because I want to get into the fall and see what's going to happen to auto prices. They started to settle down, and now they've surged back up again. And and there wasn't that much softening there. What I thought was interesting in the report. So combined goods and services inflation year over year did slow in July combined, but services remain extremely high at plus 6.1%. So, there's a lot of still pressure on inflation under the surface. And then, you take a look at where we are as far as crude oil inventories, and I'll share my screen here real quick.
I've enabled sharing, so you should be able to.
Okay, good. So you can see that right there, right? Crude oil inventory.
Sure can.
Crude oil inventory, the lowest that we've seen combined since November of 1985. So, this puts us in a situation where, a normal, if we get this Goldilocks situation and we reaccelerate, we're already at the highest energy demand or oil demand that we've seen in quite some time around the world. So you've got this commodities inflation that will not take much to ignite an inflationary storm or pressure on those services and inflation numbers. And then on top of that, God forbid, because we are at such low inventories, we had some external shock that impacted the supply. We're in a very precarious situation. Even if we do continue this slowdown, we're walking a tightrope. And we're not 10 feet off the ground. We're 60, 70 stories off the ground, and a resurgence of inflation, even with their ability to manipulate these numbers for their own benefit, to tell us how great things are, can do a tremendous amount of damage to this market right now. So the question is the market overestimating this disinflationary story? And it's highly probable, highly probable.
Well, the whole story really, as far as I'm concerned, hinges on watching these improbable market rescues that happen over and over again, right? So last October 2022, the market started to sell off a little bit. And I don't know why, but the Fed freaked out, throwing 400 billion back into the markets in 2 weeks, right? Mm-hmm. And of course, I think we're still burning that off. I mean, I'm old enough. I mean, when I first started tracking the Fed, Paul, if they put 5 billion in a month, I'd be out there pounding on the table telling people to buy gold and silver because it's over,
Right.
This is it.
And now the numbers from the Fed, and then the fiscal, stimulus that's taken place, the willingness of the government to just put us into an irresponsible debt burden situation is insane. For what, short-term market benefit?
Yeah, I mean, they're just day trading everything at this point in time. But that's a really, can you put that oil inventory report back up again?
Yes, I'll put that
I've
back up.
not seen that one. I like that combo chart right there. That's awesome. Um, and so the one other thing I want to add to that story then is, so this is U.S. above ground crude oil inventories. A piece of the story I tell my people about pretty regularly is there's below ground inventory too, in the sense that with the shale plays, it used to be true that, you know, if you had like conventional oil, you drill a well, you put into service, it flows at a certain rate. That's that. But with the shale, you can drill a well but not complete it. But you have all the logs, so you know what that's going to flow at when you complete it, meaning you frack it and put it into production, tie it into the pipeline or however you're gathering, right? So those things are called drilled but uncompleted wells, DUC. They call DUCs, right?
Mm.
And so that represents below ground inventory. Those are also as low as they've been in a very, very long time, and maybe 10 years or so. So we've burned through the underground inventory as well. And by the way, little extra English on that ball for me is that I'm reasonably convinced, based on discussions with people in the business, that
Mm.
of those ducks that remain, there's a couple thousand of them. Of those that remain, not all of them are all that good. So guess what? If there were 8,000 ducks at one point, you're going to complete your best ones. You know that from the drill logs, right? And
Right.
so it's not even like, well, we had 8,000, now we have 2,000, we have 25% of what we used to have in underground inventory. I bet we have 10%.
Right.
Just based on that little. So we don't have above ground inventory, we don't have below ground. So that is the Goldilocks story, which says, hey, this all works out as long as nothing bad happens to oil availability in this story, right?
And then you add on top of that, you know, we are at the mercy of the Middle Eastern producers at this point, you know, with Saudi Arabia's voluntary cut, you know,
Yeah.
and they're shifting politically to secure relationships with what our administration are considering our enemies at this point. So, you know, that's a major global shift. We are in the weakest position that we have been because we used this drawdown to for political purposes here in the short run, and it puts us at risk of you know, external shocks or global political shifts that do not work in our favor.
Yeah. Now this all's a little bit frightening sounding. So I'll tell you, I mean, I told my subscribers this, and I even tweeted it out that, you know, Evie and I just very innocently, we were shopping like it was 2021. We just threw stuff in the cart. It wasn't much, you know, it was just an in-between shopping trip. And we had maybe 25 items in the cart, and it was a $250 bill, right? So I guess the average cost per item was like $10, you know, and we made some rookie mistakes, right? You know, we bought pistachios and 2-ply toilet paper, and actually bought 3 1-pound steaks. You know, it was really profligate of us, but we did it, you know. At any
They were
rate,
so good.
but then somebody on our site, I think it was Permy Girl, made a really incredible observation saying that she's just watching in the stores, and she's seeing now what appears to her to be elderly couples where it used to be just one of them would come shopping. Now it's a joint decision, and they're sitting there and they're getting the pens and paper out, and they're making calculations like, can we afford this chicken for
Mhm.
Sunday dinner with the family? Like there's real trade-offs. And so this must be getting hard on people. And so, you know, from a retirement planning standpoint, like how do you even begin to approach this with people now?
You know, it's a terrible situation, and there's so many different conversations that I have had. You know, I had a consultation recently with someone in their early 80s who was scared of the market, retired in the year 2000, could get a CD paying 7% at the time. Well, they felt really good up until 2006, 2007. You know, they missed the market declines, but what they didn't realize was, you know, even the position, the path that they chose was at risk because the government drives rates down to 1% or less. So they spend 10 years where they can't earn anything on the savings that they have. Well, they made substantial cutbacks, and you know, they were good savers, so they gave up a lot of their lifestyle choices. But now they're coming in going, okay, what do I do? Food costs and insurance costs and tax costs, and oh, we had to repair the car, and instead of $500, it was $2,500. You know, what can we do? And it's heartbreaking because there's not much margin for error for them, right? there's not much of another alternative. And I have seen, like you said, I noticed when we were on our fishing trip, we were in a little town called Alpine, Wyoming, and went to the grocery store to gather everything. And I'm seeing people in the store with calculators there trying to make sure that they're staying within their budget, because all of this inflationary pressures is going up across the board. And one of the saddest situations I saw last week, I was had to go to Walmart. I rarely go to Walmart, but I had to go get something for my son college dorm, and I go to check out. There's like 7 or 8 buggies that are just full of various items. And I got to the counter and I asked the cashier, I said, so what's the deal over here? And she says, well, the EBT cards aren't working and people just don't have the cash to purchase anything. So, they have to put them over there. So it's heartbreaking. And the thing that frustrates me the most is, the individuals making the decisions. What is it? Jerome Powell's net worth is well north of 100 million. Most of those in positions of power are so protected from the inflationary pressures at this time because of their net worth, that they can absorb it without thought. They're truly detached from the reality of probably 75 to 80% of Americans that are out there. And when you get individuals in the top 10% of the income earning range that are starting to really alter their decision-making process, that just tells you how bad it is across the board. And that may be a reason why credit card debt just hit $1 trillion for the first time. And according to Charlie Bolello, we're up 16% or so. I'm off on that number a little bit, but 16% surge in the past 12 months. So people are having to resort to more debt to absorb this because salaries are not keeping up with the inflationary pressures and the food costs and just the basic cost of living, with all the things we need are going up in value and the things we want to. It's heartbreaking.
That's interesting. So this actually is an argument for why I'm still convinced that the Fed's going to cut a lot, just like everybody is. I don't know when, right? They'll re-stimulate this whole thing, because the alternative is a pretty hefty wipeout. Can you pull up, before we started this recording, you had a chart there which showed, I believe it was auto loans and credit cards
auto
in
loans,
one spot.
credit cards. Yes.
Yeah. Can we just take a look at that? So, oh my God, are you kidding me? Auto loans are now what? I'll just guess 1.6 trillion.
1.6 trillion. And, of course, credit card debt jumps over $1 trillion here. And this data goes back to 2003. During the housing boom, you had everybody just excited. Of course, it peaks, it pulls back. People get a little bit scared of that debt. But the Fed comes in and bails us out back in the 2012-13 Operation Twist and QE1. They had a great opportunity to let some pain enter the system for people to, without as much economic risk that we have right now, for people to get that debt under control. And then it's interesting, we started, accelerating again, reaching all-time high right before 2020, right before the COVID lockdowns. And even with that massive amount of stimulus and paying people more to stay at home than what they would normally get with their unemployment benefits, and we hear all these reports about how credit card debt's being paid down, the consumers saving this money and they're putting it to use wisely. You barely had a dip in this, and now we're reaccelerating again just in time, or right when credit card debt interest hits an all-time record of 25%. So that's taking more money out of individuals. And then another report by the Kabisi letter comes out and says that 36% of Americans right now have more credit card debt than savings. And it's just heartbreaking. It's absolutely heartbreaking.
That's an unbelievable chart to me. Particularly, you see that little dip from 2020 on down. So people did take their stimmy money, right? Their stimmy checks, and they worked some of their credit card debt down. But it's just been nothing but a straight ride up since then, right? So they paid down, looks like, for about a year, maybe a year and a quarter, and since then it's just been like a straight climb up. And also from auto loans, I can't detect that there's any sort of distress or concern or worry there in that chart. I'd like to see the delinquencies against that, but that's an astonishing thing to me. That's doubled in the last 10 years, doubled.
They sure
So that's
has.
two. Yeah. So we'll call that 2.6 trillion just in credit cards and cars. And
Correct.
then mortgage costs are obviously going up a lot, not for the people who have homes or sitting on their 3% mortgages, but for the people who are trying to buy in now at 7%, right? Obviously you're getting much higher interest payments here. We got student loans. They keep saying they're going to have to pay those back eventually, but I think that hits again this fall for a lot
That
of
hit,
folks.
that hits again in October. Now the Biden administration has used some loophole to keep a certain threshold of individuals on the income level to where there's no penalties to make payments, and there's not, in other words, if your income's under X amount, which I cannot remember what that level is, if you don't make the payments, there's no consequences to that. We're not going to garnish your wages. But according to the Kabisi letter and the tweet that they put out recently, so right now we're at a record 17.1 trillion in household debt. We're at a record 12 trillion in mortgages. And what's really interesting about that is that's more than double the 2006 peak. So 12 trillion, more than double the 2006 peak. And the fascinating thing is, when I talk to all the real estate agents and all the reports you hear, we've got cash buyers, we've got cash buyers, we've got cash buyers. But if we've got cash buyers, which obviously there are, especially in our area that's taking place, but that still, doesn't reduce this debt level that we're increasing in the mortgages at 12 trillion, double 2006. I did not realize that. I knew it was high, but not that high. 1.6 trillion on auto loans, wow. Record 1.6 trillion in student loans, and of course the 1 trillion in credit card debt. So it's a precarious situation. I mean, debt, the borrower is servant to the lender. The borrower is servant to the lender. And I'm with you. I believe for some time that at some point we're going to have a calamity in the market. Mm-hmm. And that will provide some deflationary pressures in the short run. But based upon the actions of the Federal Reserve and our political leaders over the past 10 years, there is no fear of debt, right? That the populace doesn't seem to be scared of debt or respect debt at all. I think it's like handling a rattlesnake. And I can tell you story after story over the past 25 years of working with retirees that didn't think debt mattered until they got into retirement. And then, we try to warn them, and then all of a sudden they're having to go back to work because that debt does matter substantially, especially with inflation starting to come along. Mm-hmm. So, but my thesis has always been we have a hiccup in the market. We try to go back to reality. Market drops 30%, maybe 50%. However, to get back to historical fundamentals, we really need to drop somewhere in the neighborhood of 50% to get back to reasonable long-term textbook investing backdrop from a fundamental standpoint. But then the Fed and our leaders realize, if you're a government official and the market drops 50% and we have another Great Depression, right? The populace is going to clean house. You're out. Your legacy, you're going to be pushed out. They'll put anybody in office to try to get us a better situation. So what are they going to do? Because there's no restrictions apparently on their ability to print. So they slam rates to zero again. They go, oh, hey, what we did there in the pandemic worked great. Kick the can down the road 3 years at this point, and they print a massive amount of money, which leads to a currency crisis and inflation that gets out of control. And, we don't know when that's going to be, but I spend a lot of time working with clients and, hey, here's where you are. This is where you are in your plan. You're on track. But if we have this event, these are some decisions that we'll need to make just so when you're ready. And hopefully you're 1 or 2 steps ahead of the average person so you can protect your purchasing power and maintain your financial freedom.
Mm-hmm. That's so important. It's so important. There's no good way for the math to work out in this. And so that another articulation of that theory is the one I fell in love with because it was so simple, because it fell under the words kapoom. That was Eric Jansen of iTulip back in the day. The ka is the implosion, and then the reaction is the explosion, the kapoom, right? The deflation to scare everybody. And then, of course, the Fed has to ride to the rescue, but that's just the arsonist putting out the fire they just set, allegedly, right? But all they do is they make the next fire that much larger, because they haven't allowed a what we call a market clearing event. We haven't had Joseph Schumpeter's creative destruction. We haven't allowed the rot. If 1 out of 8 companies are zombie companies, let them go under and create space for new companies. If GM doesn't deserve to operate, hey, guess what? The other car companies will come in and do a better job. That hasn't been allowed to happen because we don't live this whole idea, oh, we have to protect democracy. Like, dude, you can't even prove the votes were real.
No.
Oh, capitalism. We don't have capitalism. Capitalism is bad ideas go out of business. But so there's a
Right.
protected class in there, that's been protected and protected and protected. And of course, uh, that creates the inefficiencies we have. So anyway, I think that the numbers we just reviewed, right? So if we have 12 trillion mortgage debt, we've got 2.6 trillion in credit card and auto debt. When we add all these numbers up just on that side, let alone what's going on the corporate side with all of their borrowing, there's not a chance in the world that the Fed is going to allow a true deflationary spiral to get going, because that takes the system down. And then the people that the Federal Reserve is sworn to serve get harmed. And that, of course, is the banks,
That's
right?
right.
So I don't think they'll let that happen.
Well, I don't think so either. They may use it to further consolidate the banking system. And, I'll never forget, I had a client tell me in 2007, 2008 or so, because I was screaming to people, hey, we've got troubles coming, we've got troubles coming. And, and really started pushing individuals to sell some of the local thinly traded stocks. And I was getting
Yeah.
some pretty nasty calls from the local presidents. But as the crisis started to unfold, I had a client that was relatively well politically connected. And my eyes were open at the time. But honestly, Chris, I thought he was kind of kooky when he made the statement. He said, what's going to happen over the next 3 to 4 years, depending upon when it falls out, is the government's going to take out the small banks. They're going to allow the small banks to fail. They're going to backstop the system of the banks that are coming in and buying these small banks. And that's exactly what we saw happen. It wiped out most of the small banks in the small communities. And I had been talking with a few individuals. I was like, hey, this is an opportunity. We sidestep this market downturn. Let's take an opportunity to go out and raise some capital and start a bank. And then all of a sudden they raised the capital minimum to start a local bank to, I think it was 500 million at the time. I'm picking a number, guys. That number may be off, but it was a huge number, which closed further raised the barrier of entry. And what have we seen? I don't know. I don't know of any small community banks that have been started over that period of time. I'm sure there are. I've just not seen them, but there are much fewer. And now we've got a situation where they may use it to further consolidate that banking system, where you've got, much fewer banks, which are a lot easier to control.
Yeah, I mean that's certainly, obviously we've been seeing that sort of overt consolidation across everything, right? Which is just sort of the trend, and the trend is not our friend in this case, because it means 6 companies own most of the media, and they want to get us down to, I think, 4 banks own almost all of the banking ecosystem, because then it's easier to do things like introduce your central bank digital currency. It's easier if everybody's locked in one ecosystem. But of course, we've been seeing the other trends around that, which is the debanking, right? Highly concerning, to me, to see even one example of that. But we have many now. And I'm not
Yes.
just talking the big ones, Nigel Farage and Dr. Mercola. Nigel
Mm-hmm.
Farage put out a survey on his Twitter. He's like, this happened to anybody else? And all these people piled in. They got debanked, right? And almost all of them think that it was because they expressed a wrong point of view,
Right.
at some point,
But
right?
that's absolutely terrifying, because the banking system is so integrated into our society. You just cannot operate with cash anymore. There's a lot of people, the places that just won't accept cash. So if you're debanked, you're effectively cut out of society. Add on top of that, cutting you out of social media or anything else. It's an absolutely terrifying, Orwellian 1984 situation. Now,
Well, I mean, if the government is going to say we have to regulate and we charter a bank and the bank has to follow our rules, so they
mhm,
set up the conditions, and then a bank is allowed to essentially deplatform you, take you out of the system, you're being deprived of your liberty, and you're being deprived of your basic rights, I think. But
absolutely.
that's because the government set the conditions for that. Just because there's an intermediary doesn't, to me, it's still, this is the government saying they're okay with that. The government, if it was at all protective of our interests, would step in the minute debanking happened and said, "Oh, sorry, bank, NatWest, did you do that? We're going to decharter you because that's a foul. You were not allowed to
Exactly.
do that."
Exactly. You should be dechartered and banned from the industry with everyone that was on that board and that decision making process. So, One thing I wanted to point out here, not to change the subject real quick, but this should be it right here. Or what are the banks doing right now? Can you see that, Chris?
Yeah, I sure can.
So I'm gonna flip back to that debt. So one of the things that we see in auto loans, credit card balances is people are obviously having to borrow money to purchase these cars, right? With interest rates on auto loans at 7.2 or 7.3%, that's a little different right now. So, Holly and I are talking about when we purchased that car, I'm like, there's no way I'm gonna go borrow the money at 7% or 5. I think somebody offered her 4.5 because her credit's so good. But just pay cash for that because it's not worth paying that higher interest rate. But what we're seeing here is this debt is needed to sustain the sales of the auto loans right now, or at least that's what it appears in this chart. Okay. Consumers are continuing to borrow on credit card debt to make ends meet. And if you're a part of that 36%, you really don't have a whole lot of a choice right now, because if you've got more credit card debt than you do have savings in there, more than likely that's your primary source of spending. But then we look forward at this chart that Jesse Felder puts out. Tighter lending conditions are taking place. So you've got consumer credit outstandings relatively high. It's not adjusted yet, but the SLUS bank willingness to make consumer loans has dropped relatively dramatically.
What's a SLUS? What is that?
That's a good question. So that's the I can't answer that, Chris.
Savings and loan, something. Anyway, it's a survey. They're surveying. It's a survey of a bank. I'm taking it to willingness to lend, or
it's the I can't remember the acronym right now, but that's
bank willingness to make consumer loans. Willingness.
What is the SLUS acronym?
Consumer credit outstanding year over year. So
that is Senior Loan Officer Opinion Survey. Excuse me. So that's a quarterly survey. Makes sense.
Okay.
Yeah, that's quarterly survey of up to 80 large domestic banks and 24 branches of international banks. So this is at the senior officer level. And so that's what that is. And it points to, now that's not occurred yet, but the planning at the highest level points to tighter lending standards. So that is another tailwind. That's another impact that could hurt the consumer and the individuals that are having to borrow money and potential retail sales in the future if it's that credit driven, especially auto sales.
Well, every time credit growth goes below zero, it's a hyper emergency for our credit addicted system. It's a big problem. So that's where 2008. When we talk total aggregate, that I follow the TCMDO series on the Fed's website, right, which is total credit market debt outstanding, and so that's everything: auto loans, student loans, corporate loans, municipal, federal. It's everything, right? That thing it's only time in the series, which starts about 1950, that ever went backwards was from 2008 to 2009 and went backwards slightly. And that was when, Hank Paulson's writing memoirs. Gosh, we were hours away from complete disaster, right? Yeah. So we have the system, like the credit must go on. And I'm convinced that this operates at a fairly high level. And so they watching this, I guarantee you that this was part of McCarthy's caving over the federal debt ceiling, because it's sort of that the thing that we might have, well, it's sort of, if the private side isn't borrowing, I guess the public side needs to, right? So somebody's got to step in, and I bet you anything, some big bankers opened up a book and said, now listen, McCarthy, we're gonna there's nothing we can do about this. Our SLU survey says we're about to start going into a negative territory. Let me explain what happens if we go there. Okay. Every one of you gets kicked out of office because it's going to be a barn burner of a Great Depression. So it's time for the public side to do its part of this story and pick up the pace, right?
And he was probably reminded we have extremely strong influence over the media, and we will ensure you that we're going to blame you for this. This will be something you'll be remembered from this point forward. That's the most concerning thing about it.
Yeah, but the point here that I like to get to is that when you step one further back from that story, you go, okay, so the story is we have to have our debts grow forever.
Right.
Okay. How does that, at what rate? And the rate has been twice our underlying economic growth, right? Or more. And so that's the story. We just have to borrow more forever. And that's the thing when you talked about that delusion of Washington's like, well, debts don't matter, consumers, debts don't matter. We'll always get bailed out. None of it matters, right? So anything goes. But that I can feel that story coming to a conclusion here. I don't know if it's this year or next year or 10 years, but it's coming to a conclusion. And that conclusion, I believe, is going to lead to the destruction of the currency system involved.
Yes. And we're at a point now where the only way this is sustainable is salaries are going to have to go up relatively dramatically. Or we're going to have asset prices that are going to have to come down. We don't know at what point, where the inflection point is or how far that can be kicked down the road. But the reality is, as an investor, having conversations and you listen to the financial media, oh, profits are at all-time high. Yes, profits are at an all-time high. I mean, it's unbelievable the amount of profits in the corporate and the S&P 500 index at this point. But let's say that the next phase of kicking the can down the road is wage increases. Okay.
Mm-hmm.
Well, if those wages are not going to be able to increase dramatically with this level of debt out there without impacting corporate profits. So that's going to put the U.S. markets in a potential risky scenario where you have another lost decade like you did in the 1970s during that higher inflation, or you have a 2000 to 2014 period. A lot of people forget because it's outside of the most recent 5 years. The S&P 500 went flat from 2000 to 2014. And that's great if you're 40 years old and you're working and you're dollar cost averaging into the market, because as it goes down 50% in that period of time, you're buying a lot more shares. But if you're unfortunate enough that, God chose the time at which you would be born to the time that you retire, you can't, if you're 60 years old or 65 years old, you really can't kick that can down the road 14 more years to be able to retire till you feel more comfortable. You got to have a plan in place that will deal with that. So,
well, let's very quickly, because you mentioned, services inflation seems a little sticky. Now you just mentioned wages. I saw this headline. Wall Street Silver put it out. So I think I retweeted it saying that if this is correct, UPS drivers, senior UPS drivers through the union had just negotiated that they're going to have salaries of $170,000 a year for their senior drivers. Those are people who've been there for 5 years or more, right?
Wow. That's 5 years or more. Mm-hmm. They shouldn't have any problem finding drivers at that rate of income at 5 years or more. Well, and I had heard, I know some individuals in the airline industry that there are negotiations out there to give 30, 40, and 50%, in that range, not specific pay raises to airline pilots.
Well, they lost a lot of them because of the vaccine policies,
yes.
Unfortunately.
Yes, they did.
So that's a self-inflicted wound. But it's interesting because I was just no good reason, but I was just pricing out airline tickets to various places, and I was shocked. It's pretty darn expensive to go to some places now.
Yes, it is. Yes, it is. And it's amazing just how much more expensive it is from 10 years ago. And people are paying it, but they're choosing to pay it, or they're putting it on a credit card. Some people obviously have the cash that they're paying for it and have a chance to travel. So there's a lot of pent-up demand there. It was interesting. Airline prices didn't increase as much in the data as what other areas did. So that there must be a little bit of impact to demand from where the current prices are right now. So, yeah. But the interesting part is, we had talked last week about this being the danger window for the markets. And I still believe that we're in the danger window, right? So we had Silicon Valley Bank fell March of this year. You had long-term capital management fell in 1998. In March, you had Bear Stearns collapse in 2008 in March. Now, those were two completely different outcomes because the intervention and just the speculative backdrop in 1998 and the Fed intervention allowed the markets to go another 2 years before we reached that peak and had that 50% decline. 2008, we had all this optimism going into summer. We started to falter into August, and then you had the collapse of Lehman Brothers in September. So we really don't know where we are right now. I mean, there's an unbelievable amount of optimism in the markets, but we're still in that danger window. And we're, even historically, seasonality, the market should drift lower from August till November. Not a prediction, because there's still a lot of euphoria out there right now. But I always try to come back to what should an investor do right now? How do you make decisions in this environment? If you're concerned about the economic backdrop, the resurgence of inflation, that should not be good for the markets. That means that the Fed, if they're going to do what they say they're going to do, stay higher for longer. So the conversation that I have with people is know where you are in your long-term plan. Okay. The two investors that make the biggest mistakes are the ones that are ahead of schedule and greed takes over, and the ones that are behind schedule and desperation takes over. So there's no fuel to speculate like desperation, but sit down. This is a time where you want to sit down, take a look at your long-term plan and say, okay, am I on track? If I am on track, what is my margin for error? And if your margin for error is, backed into today's dollars, 100,000, well, you know what you can speculate with. Okay. If you're behind schedule and your current trajectory gives you a 20% probability of success going into retirement, then, your indication or your natural instinct is I have to gamble. But every time somebody that I sense desperation in somebody that I meet and I have to show them their picture that they're behind schedule, Proverbs 14:2 comes to mind. And that's, Proverbs 14:2 says there's a way that seems right to a man, but its end is the path of death, something along those lines. So, your natural instinct is to speculate, but sometimes, you're better off to just be patient, realize that your margin for error is low. And what's the one thing that can increase that margin of error dramatically? It's being in a position to sidestep one of those major market downturns, so that when everybody is forced to sell or everybody is panicking and selling everything, that is the time that you want to speculate. You don't want to speculate on what everybody's talking about. You want to speculate on the opposite side. Now, I am not saying go short the market right now. I think that's a very dangerous thing. But the point being is, as an investor, what we can do is really take a look at where you are right now and assess that situation. I think this is a time to be patient. It's a time to choose your exit points. If you're invested in the market, at what point, if this market drops, am I willing to get out? Of course, the market might drop and take off in the short run. But going back to that Wework bond, Chris, that you showed there, if you sold at that first spike, you felt like an idiot for 24 months, but then you were vindicated 3 years later. Might be the same situation here, but if you've got a plan that you're working with, it'll help you make good informed decisions. And you're prepared mentally, just like the conversation you had. Oh, I lost his name, the individual that you interviewed yesterday that came out this morning. He was talking about how, exercise and preparation and live planning.
John Lavelle.
John Lavelle. Yes, that was wonderful. And I'm sorry, John, that I forgot your number if you have that name, if you haven't seen this, but it was a great interview. So much wisdom there that can be applied to the portfolio process too. You stress test and you plan ahead so that you're 1 or 2 steps ahead of the individual, and you're not caught up in all this euphoria. You're operating on a long-term plan. And in my 25 years of working with individuals, yes, there are speculators that get lucky, but those that lean towards too greedy or too desperate end up in a much worse situation down the road at some point than what they were when they originally started that journey.
Yeah, well said. Well said. And of course, we have to diversify, because we don't know what the future is going to hold. We don't know what the Fed is going to do, right? We can guess. I hate that we have to guess. I'm old school. Paul, I would like to be that guy 200 years ago where you're on a gold standard, and if you buried your savings in a can in the backyard, 100 years later, it had the exact same purchasing power, right? I can't do that. So that means I have to play the game. The game is, what are all these complicated things I have to do to try and stay ahead of what I know is a rate of inflation that's badly understated. I know what my actual experience of it is, right? And so that's what I decry, is that they set up a system where you have to play, and then they rig the game, which makes it really hard to play the game, and stay ahead. They make it hard, but not impossible. So I think that's why you have to have a really disciplined approach, because it's the only thing that can really keep up with this game, because they are masters at taking advantage of your desperation and your greed. Yes. They do it every day. They're very good at it. It's how they roll.
And they're patient. They play the long game. They really do. So some of the best advice I was given probably 10 or 12 years ago. I was so frustrated with some of the things that were taking place, and I'm venting to a client. You know, we're in this spiral where we're talking about all the bad things that are going on, just kind of complaining. And he stopped for a second. He said, you know, he said, I was given some advice by somebody 20 years ago. He said, you have to play by the rules of the game that are forced upon you, not the rules of the game that you know they should be. And that's the hardest part for individuals like ourselves, I would think, and those that want to know the truth. They understand the historical standpoint, what is right, what is good versus what is evil. And I do believe there's a lot of evil that's taking place in the rules of the game as we're having to be played right now, because they're stacked against the average person, and the government should be for the citizens, not for their donors. And so, you know, we just have to play the rules of the game that are forced upon us, and hope that if we can play them well, there'll come a time in the future where we have enough influence to where maybe we can, you know, help put people in place that will change the rules of those games back to an honest and righteous rule set.
I agree, and I'm really hopeful for that day. I'm a rip the Band-Aid off kind of guy. I want this to happen sooner than later, because can we just? I'm tired of all the waiting on all this stuff. I've been waiting a long time, but you know, I learned a long time ago that I no longer invest according to what should happen. I invest according to what will happen, and increasingly that means I trade like a criminal, meaning, you know, I do the opposite of what's obvious and right, because I'm pretty sure that's what's going to happen, because that serves a narrative, it serves the moneyed interests, it serves something other, you know, but it's, you know, that's work. The only place where I'm sticking to my guns and I'm sticking hard is I am convinced beyond a shadow of a doubt that they are going to destroy us on the commodity side, because they just live in this world where none of these people who are making these decisions at the highest level, none of them have worked in a mine, none of them have worked in a farm or a productive, you know, capacity like that. And so they got their little bubble echo chamber. And so I'm watching what they're doing on the production side of all of this, which is miserable business anyway, right? You know, if there's a $5 box of cornflakes, there's about 7 cents worth of corn in there to the farmer, right? You know, the producers get the least in this whole value chain, even though they're the origination of the whole value chain. So I'm convinced
they're the ones that we want to be receiving the largest majority of the profits, so that they continue to produce, they produce well, and they do it in as clean and efficient and healthy a manner as possible. Sorry to cut you off, Chris.
No, great point. I would love that our farmers had enough extra that they could let a field fallow for a while, because that would be doing the right thing. They should be getting 14 cents out of that box, or 21 cents, or dare I say 250, right? Yeah. Because then, you know, then they would, you know, actually have the financial wherewithal to do the right things, which is increase production in the right sorts of ways in a sustainable fashion. You can't farm sustainably at these margins, right? One hailstorm and your margins are gone, right? No. And anyway, so decrying all of that, but I'm convinced that silver, because the whole story there, right? You know, it's depleting. There's only so much. Most of it's a byproduct of base metals. Base metal mines aren't opening for some reason, mostly regulations and capital costs and things that it just doesn't make sense under the current terms and conditions. But in oil too. I'm watching, Paul, this great destruction on the productive side, as if it doesn't matter. And I feel like I'm caught in one of those strange movies where I'm the only guy seeing something, or one of a few only guys, you know, but I'm just like, this is bad. This is a bad idea. You know, and we're doing it, and we're demonizing that. You know, I'm watching like these windfall taxes out of Europe and the UK in particular on oil because they're bad. I'm just like, no, you guys, you really need that. You're going to need that oil. Right. Yes. So I see that setting up. I think those represent, and this is just, you know, sector level talk. I can say this. I'm convinced that there's going to be a great resurgence in the commodity bull coming forward, just because we've done such a terrible job of stewarding our mine output and our oil production output against known demands.
Right. And you take the graph that we showed earlier, where you were at a limited supply, you're at reduced supply, not supply, reduced inventories. Yep. Everything that's taken place. I mean, if you're a major company and you have a huge amount of profits come in because you're prepared for that, and then you got to worry about windfall profit taxes. you're freezing that money. You're not going to reinvest it back into new supply. So everything is constricted. And then, so in a normal environment, we're going to have prices rise because of the demand and lack of supply over the long term. Imagine on top of that a wall of money being thrown at this again, which will just further accelerate. So I do as well. I really like the commodity producers. I really like a lot international. Not a recommendation for y'all. You have to talk to an advisor before you go into a specific category, or make sure it's appropriate for you. But I really like precious metals long term. You have to be patient. But I really like precious metals long term. I really like energy long term. I really like your international countries that are commodity production heavy. And so there is a huge amount of opportunity out there for the patient investor, and for those who are willing to accept a little volatility in the short run or long term, or wait until the opportunity presents itself. You're never going to have the perfect opportunity. There's always going to be some risk when you make those investments. There's going to be some concern, but when you look at the long term picture, it's an incredible backdrop.
Yeah, and there's only one continent left that hasn't really been picked over, and that's Africa. And news stories of the past week, part of the way I decode those is I'm watching. That's a great resource battle, and it's a pull between East and West, and East is winning. East includes Russia. And I've seen charts like, oh my gosh, Russia's influence in Africa. I'm like, now do China, because it's even redder than if you're reading in all the states that still seem to be swinging. So I put Russia and China East in this story, and so but that to me is just this resource story. I mean, that is uranium, that is precious metals, that is cobalt, that's nickel, it's oil that hasn't been explored. There's a whole Rift Valley there that I don't think's been drilled out yet. Africa's in a massive, huge continent, and it's been barely touched. So I think that's where the battles of the next few decades are going to play out, as it were. But if that falls to the East, in essence, the West is pretty well picked over. I mean, we got more stuff we can mine, we got more holes we can drill, but it's been pretty well, it's been picked over.
Well, and with the attitude that's in America right now, there's going to have to be a tremendous amount of pain. And I had a friend that does a lot of counseling and addiction therapy, and he says, really, the only time someone changes is the pain of changing is easier than the pain of staying the same. And so, we would have to experience a lot of pain. And you speak about what China does over in Africa. My uncle for years has been supporting ministries in Kenya. So his daughter, my cousin, was killed in a car accident probably 13, 14 years ago or so. So they've been building churches in her honor. It was a terrible situation, but for anybody that loses a child like that. But they've been building churches. And he said one of the most amazing things that he's seen in the conversations he's had with these pastors over there is China comes in, they're building roads and supplying motorcycles for these people. And he said, just in the past 13 years, you go over there and individuals were walking from community to community. Now they're on motorcycles, affordable motorcycles, and driving back and forth. And, China comes in and builds a manufacturing plant. And he says, they know they've got strings attached, but they're really a blessing when they come into a lot of these communities and countries over there, which is a lot different than what the U.S. does. We go over and give them a lecture. And of course, they're going to turn to those that are willing to help them, even though they do understand those are strings attached at some point in the future.
Would you prefer to have a road or a lecture on diversity and inclusion?
Yeah. And they think we're crazy for all that lecture anyway. So just a mismatch of ideals. We really are.
Yeah. Well, I do think that these next years are about who has access to those resources, and China's just acting as if that's obviously true. And so they're forging relationships and making loans and putting their money where their mouth is, and bringing over dignitaries and treating people well and feeding them with big state dinners, and they're working it from a political diplomatic angle with a sort of a win-win baked in, right? We get something, you get something, it balances. Where I think the West is still principally sort of a bully, we're going to hit you over the head, and if you don't like it, we'll hit you harder, and you're going to do what we want you to do, right? So that's what happened with like Libya, right? NATO came in and destroyed that country, destroyed it. Gaddafi took that from 146 on the development list of countries all the way up to higher than any other BRIC at the time, right?
Mhm.
Higher living standards than China, right? And he did some pretty unspeakable things, like he didn't allow foreign oil companies to come in and take the oil, and he didn't have a national bank that was, I'm sorry, central bank that was tied in through the Western central banking system. But then he did the ultimate unthinkable and said he was going to make a gold-backed dinar. 2 weeks later, there were NATO planes flying over there, bombing.
Yes.
Okay, so it went from, and by the way, for people who don't know the story, if you were starting a household and you wanted to buy a house, they constrained the total payment at 10% of your salary, whatever that was, and the state made up the difference. If you were sick and they couldn't treat you in country, they would pay you and somebody else to fly anywhere in the world to get the treatment you needed. If you got married, there was a one-time $49,500 payment to the new couple to help them get started. So he was taking his wealth, the wealth of the country, their wealth, and distributing it back to the people. Unacceptable. Now it's an open air slave market. It's destroyed. It's awful. We don't talk about that,
Right.
that part of it. Like we bombed it and wrecked it, right? But the rest of the world hasn't forgotten that. Just because the New York Times doesn't remind us of that particular really
Mhm.
not just embarrassing, but morally destructive aspect of our history, right? We don't square up with that. We're just like, oh, that's because we did that. If Russia did that, we'd be horrified, but whatever, right? So double
You know,
standards,
if Russia did
all
it,
that.
they're evil Russia. We do it, and suppose for whatever reason, it's not evil.
Yeah. But now we're like, why is Niger turning towards Russia? This is unacceptable. It's like because they're just south and a little bit east of this place called Libya, and they observed, right? It's like
Well,
it's not hard.
what was interesting to me is apparently all of these military agreements that have taken place with these African countries and Russia, right? So if you're a surrounding country and you take a look at what happened with Gaddafi, okay, yes, we'll follow the new system that you're trying to put into place, but we need your protection because we know we see what happens over here. You're going to have to protect us. And that's
Mm-hmm.
all I could think of when I saw the headlines on all of these military relationships
Yeah.
and agreements that are taking place is they obviously want protection, and we've given them a reason in our actions in the past to feel like they need it.
Yeah. Well, and it's reasonable, right? I call it the North Korea strategy. The reason that North Korea is safe is because they built nukes. And so
Right.
we can huff and puff all we want, but there's not a lot we can do about that anymore. So lesson learned, right? So Iran is over there. And I remember for a while, it seemed pretty desperate that we, whoever we is in this story in the US, we wanted war. We killed their general Soleimani, right? With a targeted assassination, crowed about it. And luckily Trump didn't take the bait on that. So we didn't get into a war with them. But within a few weeks of that, Russia shipped their S-300 and S-400 missile systems in and operationalized them, and everything just went stone quiet after that, right?
Yeah. I'm sure they tell
Like,
other countries that when they go in to talk about these military arrangements too.
yep, because they need that protection, right? Because as soon as you can protect yourself from air superiority, everything changes in that equation, right? That's now you're talking boots on the ground, and nobody wants that. That gets hard. It's easier when you can just do
Right.
some drone overflights and have your way. But so I watched that, and so that's what I'm seeing is this great rebalancing of power, and that's what the Ukraine war has ultimately taught me is that drones are the new thing. It completely violates this idea that your armaments, how many tanks you have, how many troops carriers you have,
Mhm.
totally irrelevant until we figure out some way to defend against, these aerial assaults. And so the whole idea of what an army used to be, it's now it's up for grabs, but that's an opening that I believe China and Russia have waded in with. I'm sure they whip open the laptops and talk to the generals in Niger and go, look, they can't come after you anymore. We
Right.
can we can protect. They can't. There's what are they going to do? They going to fly here? Not with these missile systems. Are they going to come here in their tanks? Not with these drones. Right until that gets sorted out, it's a big opening, and that's how I interpret this. In that opening, never waste a moment, right? And so this is all changing at light speed now.
And building relationships in a commodity heavy, materials heavy, massive supply of resources that are available uh, to China, Russia, and the other countries, and which limits it to us.
Now, on the investment side, I'm convinced beyond a shadow of a doubt we're gonna have to get back to making things and
Yes.
mining things.
Yes.
the M&M strategy, right? So, we're going to reopen uranium mines here, after much environmental this and that. It'll happen. We're going to have to start our rare earth production back up again. It's going to
Yes, we
happen.
are.
We're going to have to put pipelines in to bring natural gas to New England and to California out of plate, even though they've blocked that forever. It's going to have to happen. Just we're going to have to get serious about that stuff. And I'm convinced there's a big nuclear resurgence coming. I'm very excited by companies that are making, there was for the first time, I think my adult lifetime, a second reactor design had been approved by the NRC.
I saw.
So that's cool. Yeah, that's cool. And it's totally a different thing. And it's, fourth gen, which makes a lot of sense. So I'm convinced there's a nuclear resurgence coming. It makes all the sense in the world. If you believe that we want to go low carbon, for however you look at it, you need nukes, right?
Yes.
Saying we want more solar and wind is actually saying we need more nukes, because
Yes.
these things are going to operate when they do, and we need this base load otherwise.
Right. Yeah, I mean, when you got that reactor online that's built correctly, a high windstorm is not going to destroy it like it will the wind turbines that we saw take place in the news here in the past couple of weeks, or a hailstorm destroy the solar power units that are out there. That nuclear facility is protected from that and continues to produce. So it's the most efficient when you look at the numbers. It's just the most efficient. So I'm glad that we're headed in that direction as well, and hopefully it will continue to accelerate.
I think it will. That is the bright spot in this story. Eventually, we'll get smart again. As long as we can get past the current crop of DC people. But hey, term limits could solve a lot here in this story. So maybe we'll get some term limits.
That would be so nice. That would be so nice.
Yeah. All right. Well, Paul, thank you so much for your time today. We're talking with Paul Kiker of Kiker Wealth Management. Again, Peak Financial Investing. We have the link down there if you want to talk to Paul and his team. No obligation. Great people. And the best part is you'll be talking with somebody who can talk about the world in this way,
Yes.
which is important. So with that, hey, thanks for your time this week. We'll see you next week.
Thank you, Chris. Always a pleasure. Look forward to it.
All right. Bye-bye.
Bye-bye.